Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over real estate, give you an update there, and I'm also going to give you an update on running out of spare capacity for oil. Great article that's written. I'll put it in the comments section below if you guys want to read it yourself, but I'll touch on some of the highlights in it, and I'll touch the highlights of the weekly housing trends update for June 25th. So let's dive into some of the data, see what I'm finding. This is the weekly housing trends data week ending June 25th. So for June 25th, that's what this is here. Your median listing price is up 16%. Your new listings is up 5%. Your active listings is up a little bit at 25% year over year. And your time on the market is 3 days faster than your year over year change. So we are still continuing to go higher on a year over year basis. House prices are not falling, but the inventory is coming up a little bit for those active listings, and the time on the market is falling at a slower rate than what it was some weeks ago. So the market is slowing, but it has not gone lower, at least not on a year-over-year basis. That is what I'm using, is the changes of year over year to take out seasonality. I'm not looking from week to week or month to month because of the seasonality in the trends. Now, jumping into running out of spare capacity, that's oil. What's next? This was written by Goring and Rosenzweig. Pretty good article. There's a couple of things I want to talk about. It says, our biggest short-term problem is that we are now running out of spare oil pumping capacity. In every prior energy shortage, including the dual oil crisis of the 70s and the rally of 2008, OPEC maintained ample spare capacity that could quickly be brought online. In past letters, we explained why the second half of 2022 would mark the first time in history that global demand bumped up against total pumping capacity. That is still the fact. I know a lot of people are wondering, why is oil prices down? Well, sometimes the oil markets don't follow the fundamentals in the short term. Maybe we're overbought for a little bit. Maybe there's fear in the market. Maybe it's emotionally driven. But it will come around. The fundamentals will show itself, and the spare pumping capacity in the world will push prices higher at some point very soon. So he goes through a lot of information. A couple of things I want to touch on. OECD inventories versus seasonal average. Here is 0. And we are drawing down on our inventories. And our inventories, this is our inventory levels. We are at a lowest inventory levels all the way going back into the 90s, mid-90s. So we are eating through inventories, and they're releasing strategic petroleum reserves to slow that down. He even talks about it. Historically, SPR releases have been unsuccessful in reducing oil prices, and instead are an indication that the physical crude market is exceptionally tight. The larger the release, the tighter the market. And we've been hitting the strategic petroleum release quite heavily here recently. So we've got some problems in the market. We can see it in inventories. We are continuing to draw down. Here's the 12-month crude contango, which we've got going way down there. What that means is that the physical markets are very tight, and people are willing to pay money up front for that crude oil. They'd rather have it today than tomorrow, so to speak. So what it says is, in periods of acute shortages, physical traders are willing to pay a premium for prompt delivery, pulling the near-term contract above the later month contract, a situation known as backwardation. Currently, physical markets are so tight that traders are willing to pay a record $17 premium, or nearly 15% for oil delivered promptly compared to a year from now. We've never seen this level of anxiety or market tightness. And that's that anxiety. And that's talking about years of underinvestment in upstream oil and gas projects. Remember, the oil industry is inherently cyclical. High prices lead to strong profitability, which attracts investments and ultimately leads to surplus production. But we're not repeating those same mistakes here, or maybe they're not really mistakes. The cycle isn't going to stop because we haven't put the capital flows into investments. Oil began to collapse at the end of 2014, and capital began flowing out of the sector. Oil and gas capital spending fell by over 60% between 2010 and 2020. Investment in U.S. shales fell by over 70%. Over the entire period, the cumulative reduction in capital spending compared to trend was more than $1 trillion. He talks about ESG and how underinvestment has happened in oil. In a normal cycle, falling inventory levels, rising prices, and improved profitability would have attracted capital back into the industry by now. But there's ESG commitments made over the past several years. They're keeping capital from entering the oil and gas industry. Oil prices are at 15-year highs, and natural gas in Europe and Asia are setting new records. And yet E&P capital spending is still down 50% from the peak, with shale spending down 60%. The spending isn't coming back despite the record free cash flows. We've got another major issue facing the energy industry. Although shale resources are extremely large, it is ultimately finite, just like any other conventional field. Like a conventional resource, a shale basin ramps up early in its life, then plateaus, and ultimately declines. We're talking about shale oil here. Remember, the biggest growth recently came from shale oil. Now, when looking at shale oil, they're starting to run out of really good drilling locations in these inventories. They called out, we argue that companies drilled out their tier 1 inventory, well productivity would soon begin falling, making it far more difficult for shale basins to grow. So they're basically hitting all of their best drilling locations where they have the best productivity out of those, and they're starting to go after lower and lower productivity wells, which they call them tier 2 wells, and they're not as fruitful. So when looking at the production profile of Carnes and Montreal, these are the production profiles, and they've basically peaked and started to decline somewhat. Their highs are not as high, and their lows are getting lower. And he thinks that we're going to roll over here soon, and it will be the peak of these productions areas, these shales. It says both counties saw production ramp, plateau, ultimately make a second peak, and then roll over. Today, both counties remain 50,000 barrels per day below their pre-COVID level. As these basins run out of undrilled locations, operators have been forced to look at lower quality parts of the basin, hurting productivity. In the Bakken, per well productivity peaked in December of 2019 and has since fallen by 6%. In the Eagle Ford, productivity is held in better, but only because total completions remain down by over 40% compared to 2019. So they're running out of locations that are high quality locations. We're starting to roll over in their production curves. Not good if that's your largest growth of oil production in the world. And it says, despite being both the youngest fields and having the most drill locations, even the Permian is not immune from the early stages of resource depletion. Midland County is 900 square miles of the best acreage in the entire Permian Basin. Assuming 10,000-foot laterals, 13,000 feet between wells, and 3 productive zones of stacked Wolfcamp pay, very generous. We believe there are at most 3,900 drilling locations in Midland County, representing 39 lateral feet of wellbore. Thus far, 24, it must be million something feet, have been drilled, implying Midland County is over 60% developed, which means that's usually where they plateau is 60%. Although Midland production is still growing, our models believe this will likely soon begin to plateau as well. So he's talking about all of the shale basins and all these other areas that are going to plateau and come on down. These are the Dukes, the drilled but uncompleted wells have been coming down to much lower levels than where they've been at. He talks about OPEC and non-OPEC basically hitting their peak production here at any second, and there's not much spare capacity in the world left for oil. Pretty I mean, just kind of saying that is pretty monumental if you know about energy and how important energy is to the world and GDP and our economies. It's pretty crazy to say that we could potentially be peaking in oil production here at any time. And then he talks about underestimating demand. Demand for oil has been increasing. So one question we are often asked is whether high prices will curtail demand and potentially push the world into recession. The topic of demand destruction is extremely interesting, and in the future letter, we will likely dedicate a whole essay to the subject. So he talks about a potential recession from high oil prices. He gets into some of the math of previous bull markets in oil, where in respect to GDP, they were around 7-8% of total GDP. That's nearly 8% of the US GDP was spent on oil or energy. Coming on down, we are right now at oil expenditures amount to 3.5%, less than half of the prior two peaks. So we can still basically go up double from where we are today. This is looking at oil. I don't know if he did it on a gasoline, diesel price because there's still large crack spreads or mining margins, I should say refining margins in that price. But it says were oil to reach 170 per barrel, expenditures as percent of GDP would reach 6-7%, more consistent with previous market tops. So 170 is kind of where his head in the game is, and 150 per barrel too. With demand running higher than expectations and non-OPEC plus supply disappointing, all eyes are on OPEC. And then he basically says that OPEC is pretty close to being tapped out. Now it's just a matter of time. He talks also about secondary fundraising. It really hasn't come back into oil and gas to have increased investments in this area. It says capital remains unavailable even though oil and gas prices are high. And even energy hostile politicians are now calling for more upstream investment. That money has not shown up there yet. So what he says is we are now beginning to understand what a world looks like as we run out of spare oil pumping capacity. Even with the huge releases of the oil from Strategic Petroleum Reserve, oil prices have hardly pulled back. Global inventories now at record lows, continue to draw counter-seasonally, and are reaching dangerously low levels. That's with demand coming offline with Ukrainian conflict and COVID problems in China. Global oil demand in Q4 will approach global pumping capability according to our modeling. So it's going to get pretty crazy here, guys. In the short term, I think, at the end of this year. Why is oil prices down? I don't know, guys. I don't think anyone's going to know that question, but guess what? If this is, in fact, true, it's a buying opportunity. And if you guys are wondering how I'm playing this, I will put on the, I'll create a post on the website down below. If you're a Platinum member, you can see how I'm playing it. I've come up with some ideas of how I'm going to play it and where I'm going to kind of overweight here going forward. And if you're interested in that, definitely check out the Platinum membership, and you can see that post that I'll be posting here shortly. All right, guys, we'll catch you next time. This is Finding Value.